Well, let's turn our attention back to the bond markets. We did see a bounce back today after we saw prices surge on the 10-year yesterday. Today, the yield moving about 6 basis points or so. Let's bring in Chris White, the CEO of BondCliq. And Chris, we were talking about the plunge yesterday in the yields, essentially saying this is part of a perception of the economic recovery slowing. At least that was our read. But you've said that there are other factors you're watching right now. I mean, what do you make of the swings that we've seen over the last few days?
Well, I think Jared mentioned something that's really important. It's sort of the time of the year. We have to look at the calendar when you're examining how markets are moving. And we can't deny that this is a vacation week in the US. And so markets do get thin and they do get choppy. And just looking at, what Jared presented, it looked like, maybe towards the middle of the week, there was a reaction to the downside in equities. But now we're seeing, equities basically rally and be flat or higher on the week. So I think part of the material movements that you've seen are due to where we are in the calendar.
And the other factor here, I mean, we talk so much of this is sort of tied to the economic data. And yet, as you mentioned off camera earlier, there's not a whole lot of yield if you're looking in the fixed income space, whether it's the German Bund, obviously nothing in Japanese government bonds. I mean, how much of this is about foreign buyers coming into the market just seeking yield as much as it is tied to the economic data?
Yeah, you're 100% correct here. I think that's why we shouldn't overreact and start looking at the treasury market the way we have traditionally as something that's going to forecast how future U.S. economic performance is going to be. It's just not, it doesn't work that way anymore. What's happening with the U.S. Treasury market is because other central banks have been easing for such a long time and have been buying their own debt for such a long time, we actually look like the best game in town when it comes to yield if you're an international investor. So it's possible for yields and treasuries, I think, to go down like we've seen this week, but it not necessarily be directly related to the future outlook on the U.S. economy. And this is where things are getting confusing. For example, Akiko, I think a lot of people are looking at the recent moves in treasuries and saying, oh, maybe we don't have an inflation problem because yields and treasuries are going down. I think we absolutely have an inflation problem that is real and material in prices. But we may not be seeing it the way we traditionally see it because we do have a lot of international buyers coming in and picking up yield in a 10-year treasury where they can't pick up any yield on a 10-year French bond, or it's actually negative yielding 10-year government bonds at this point.
What does that suggest then in terms of where we're likely to see the 10-year move? I mean, if it's not necessarily tied to the data anymore, we don't see it as a safe haven play per se. Does that suggest that we're likely to see rates even lower?
Well, there are lots of technical distortions that I think are coming out of the Fed's intervention in just markets in general. And as the Fed has gotten more active and has started direct bond buying in treasuries and mortgages and in corporate debt last year, it's very difficult to use the traditional methods of looking at markets and looking at data for future forecasting, because this is completely unprecedented in terms of the way our economy's worked in the past. For example, if you look at when the Fed announced that they were going to step in the U.S. corporate bond market back on March 23rd of last year, you can almost map the COVID recovery rally we had in the S&P 500 from that announcement. And even though the Fed didn't start buying bonds on that date, it was just the Fed saying they were going to do something that really led to, us coming out of that hole that we saw in late March and beyond what we've seen in terms of rallying equities. I think something, Akiko, that people may not have paid attention to or doesn't seem to be picked up on a lot of news channels is the Fed announced or stopped buying bonds earlier this year and then announced yesterday that they were going to start selling the bonds that they had purchased next week. So I think it stands to reason that if there was a reaction to the Fed saying they were going to step in and buy bonds, there's probably going to be an instant reaction, especially in the equity market, to the Fed saying, oh, now we're going to sell what we bought.
And you said that when you're talking about looking at the bond moves in relation to where we are in terms of concerns around inflation, you think there absolutely is a problem for in terms of things running a little hotter. I mean, we got the FOMC minutes this week that seem to suggest there is a real division within the FOMC about how quickly to begin the tightening process. In your observation, is the Fed a little behind the ball?
Well, I think it's difficult when, you're in charge of putting policy together, then you're in charge of judging whether or not the policy decisions that you've made are working. So I think that not only happens at the Fed, that probably happens in companies and probably happens in households. But what we do know today is that on a per capita basis, there's never been more money in the U.S. financial system. So to assume that under those conditions, we're not going to see price inflation, I think is a bit naive. And it depends on what parts of the market you're looking at. We seem to be incredibly focused on looking at U.S. treasuries to determine how healthy the rest of the market is, or looking at, corporate bond yields to understand how healthy the market is. We have to look beyond that. We've got to look at where prices are for commodities, where prices are for food. These are the things that I think are being sort of overlooked as we obsess over moves in the 10-year treasury.
Chris White, good to get your insight on this Friday. BondCliq CEO, good to talk to you today.